Hello, thank you for joining our Builders FirstSource Market Intelligence webinar. My name is Tim Page, Executive Vice President of Digital Solutions. Once again, this webinar features Allie Wolf, Chief Economist for Zonda. Allie will share her insights and take questions at the end of her presentation. In addition to Allie, we'll also hear from BFS team members Jeff Rettig, our Vice President of Supply Chain, Steve LaValley, our Vice President of Forest Products and Transportation, and Mike Farmer, our President of Commercial Operations. I'm going to kick off today's webinar with a quick update on our investment in digital technologies, which are designed to create value for our home builder customers. In January of this year, we brought our digital tools to market under the Take Building from Now to Next marketing campaign. These digital tools include drafting, build optimize, home configure, render, home plan library, and mybldr.com, which is our customer portal and a collaboration platform for home building. Our digital tools provide home builders with greater transparency and control over their projects while accelerating the sales process, better engaging home buyers, and streamlining construction. We'll play a short video to help you understand the benefits of mybldr.com. Processes within this one easy-to-use platform. It also allows all invited project participants to collaborate from plan intake through material procurement and job site scheduling. MyBLDR.com has a number of current capabilities, including project document storage, plan collaboration, home configure, material quoting and procurement, and all the other stuff that was highlighted in that short video. However, we are moving towards full product launch in early 2024 with a lot of new and exciting capabilities such as bid summary and pack consolidation, intelligent scheduling and to-do lists, builder catalog curation, and many enhancements to the home configure experience. So thank you for listening in on this quick update on our digital tools investment. I'll now turn it over to Jeff Rettig, our Vice President of Supply Chain.
Thanks, Tim. As was just talked about, BFS is helping drive innovation for our builders, and part of that is continuing to invest in our manufacturing capacity. With BFS components, we're helping our builders build more efficiently, more timely, and with less labor, not to mention helping produce a greener and safer job site. One of our top partners out there is Mytech. With their industry-leading software Sapphire, we're helping do the structural analysis on your project and then sending that design straight to our component plants for manufacturing. As we've mentioned before, Mytech has invested in digital capacity to meet the growing demand for components and continues to invest in truss automation and software for the future. BFS also continues to build out our national footprint in both the single-family and multi-family segments, with now over 130 component plants as part of our total manufacturing sites. In addition, we continue to invest in our existing plants with new equipment, including automation for our plants to help address the labor concerns. Please reach out to your local BFS sales associates to talk about how BFS components can help your business. I'll turn it now over to Steve LaValley, VP of Forest Products.
Thank you, Jeff, and I'll be brief with my presentation here to make way for our main event, Allie Wolf. Allie's going to give us more insight on the housing market dynamics and her outlook for next year, but in the meantime, let's talk commodities for a moment. So I think we see many, Allie will expand on this more in her presentation, but I think many economists and forecasters are anticipating continued growth in the residential construction markets. How much? It's anybody's guess, but I think many prognosticators seem to think that the forecast is going to be up, demographic trends and so forth, Allie. So when I look at this from a commodity perspective, we could quickly, if we start to push our starts and permits back up above that $1.6 million, 1.6 million starts basis, how is next time going to look different than the last time? We know that we saw plenty of supply constraints last time we went through this. So what can we do, or what can you do to help service your business going into next year? Well, one thing that BFS is doing is we're partnering with key suppliers to best align supply with the needs of our customers in all market conditions. And on the page here, I just put a handful of logos for the companies that we partner with. There's certainly more than this, but our mission is going to be to serve the builder as effectively as we can. We think that comes through in-stock positions all the time, to be aligned with the right product going into our manufacturing plants at all times. Attention to the most constrained products. Certain products are just harder to get when it gets tighter. And so we're going to look to align our supply very specifically on those. And we're definitely focused on reducing cost to serve. We think that the builder community is asking that from us. We want affordable housing. So how do we best do this together? We got to figure out how to do this more efficiently. So first of all, thanks to all of our trusted suppliers. And just for perspective, just the nameplates that's showing on the screen here, that represents about 50% of all the lumber and OSB manufacturing capacity in North America. So when we look at key suppliers, we think we've got a good list showing there. So overall, on the commodities team, and I know Jeff's team's doing the same, we're doing our part so you can focus on your part. We're going to focus on keeping you in stock so you can keep building houses. From that, I'll hand it over to Allie. Thank you.
Awesome. Thanks, Steve. And hello, everyone. I'm delighted again to be here to go through the state of the housing market. Now, as mentioned, I am Allie Wolf, the chief economist with Zonda. If you're not overly familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Now, today I have about 40 minutes to get through 3 sections. And what I want you to note that's different than normal is we just had our last presentation just about 2 months ago. And so I'll start in the first section where we'll address the state of the market. We'll talk about the changes and shifts we've seen since the last time we met. But because the other event was so recent, we wanted to take a different approach. We wanted to go through generations. We wanted to go through opportunities, challenges, buyers, different cohorts, and different trends to watch from these groups. So that's going to be the lion's share of my presentation before I finish with our final thoughts. So as we dive into the state of the market, the biggest thing that has changed since the last time we've spoken is what's happened with interest rates. So we understood, and it was really kind of a clear part of the backdrop, that because of the 11 short-term Federal Reserve rate increases, because of inflation, because of dysfunction in the mortgage-backed securities market, we've experienced rates going up since last year. And we really got to the point that throughout the majority of this year, we had stabilized in the 6%, and consumers had just begrudgingly accepted what the new reality was. Now, over the past 2 months, we've had a few changes that have changed the trajectory of those mortgage rates. When we look at what's happened, we know that the Treasury increased their issuance of bonds to help fund our debt and deficit. So they increased the supply of those bonds. At the same time, we already knew the Federal Reserve was stepping back as a buyer. Last time we spoke during the Q&A, we talked about how international appetite was changing. And we've seen a shift from investors. Investors saying, hey, you know what? Maybe these 11 short-term rate increases are not enough to dramatically slow the economy, so I'm going to reallocate my funds. And in doing so, in the combination of these 3, we've obviously seen the 10-year Treasury yield go up and the accompanying change to mortgage rates. The backdrop today is that we're looking at, depending on the day, depending on the borrower, 7 to 8% interest rates. I know today it came out at that record high at 8%, so obviously a big part of the discussion. And as we look at what's happened with rates, we've talked about this in the past where, of course, affordability is playing into total sales. Of course, confidence is playing into sales. And part of the confidence is just people questioning, do I really want to spend that much money for that house? And just pushing some people to the sidelines. But we know a huge part of the discussion continues to be that sales are inhibited by the lack of supply. And with that lack of supply, we've seen that we haven't really seen, with the exception of last year, a broad-based compression in overall home prices. So here what you're looking at is the existing home sales purple line. It goes to your axis on the left, new home sales axis on the right. And we know that we've experienced a tale of two different housing markets, where because of some of the exaggerated challenges, I'd say mostly on the supply side, we've seen that the new home side has taken more share than normal compared to the existing home side. And it makes a lot of sense when you look at the data. There are a lot of things that right now are working in favor of the builders. We talked about supply. You can track down the active listings in that chart. The line that goes not all the way through, stops at September, is our year to date. You can see still extremely low compared to where we were going into the pandemic. The slight upward trend that we're seeing is what you normally see this time of year. So I think in a good way, seeing some normal seasonality is helping us get back to that idea of return to normal market. When we look at the resale supply, not only is it limited, but we know that the age of the housing stock has nothing but aged, and those sellers that are looking to sell on the resale side know that there's not much else competition, and so they've really pushed that price up. So builders have found that opportunity to say, well, we know that the resale market isn't working for you, so why don't you consider some of our quick move-in homes? It acts like a resale product. You can move into it within 90 days, but it's also brand new. And if that's not your jam, builders are also offering still those to-be-built homes, which have become more attractive than they were over the past few years because cycle times are coming back down. And for consumers, when they look at something, okay, I can pick my lot, I can pick my finishes, I can customize it, I think that can help some people get over the confidence thing and really can justify them being able to pay today's prices. What we're also finding working in favor of builders is that new homes are a luxury good. Always have been, always will be, but this price spread between new and existing homes has come down. So at least when people are looking at their options, new looks a little bit more compelling, especially when combined with the incentives. We know that incentives are such a big part of the market today. They're really the key thing to help seal the deal. When you look at the share of projects that are offering incentives, it will vary by market. On the low end, Seattle, about 50% of all of the projects offering incentives. On the high end, Jacksonville, Florida, at about 90%. We got to make sense of what incentives are the most effective. And the top two come down to mortgage rate buydowns and fund towards closing costs. So if people are monthly mortgage payment sensitive, we know that those mortgage buydowns can go a long way. And even as we've had interest rates go higher, there are some builders, in particular the larger builders, that can still offer a 30-year fixed rate mortgage on the extreme end in the 4s, but more often you're still seeing buydowns in the 5%, which for some people is enough of a threshold that they're still willing to go through with the purchase. Funds towards closing costs will be more targeted to those that are maybe tight on cash. And so that's just going to help them. Maybe they can service the monthly payment, but they just don't have enough cash for the large down payment and those overall funds. So we know that we've had this tale of two different housing markets. We know that the new home market is still outperforming, but we also don't want to be Pollyanna about it. We're fully aware that new homes are also not immune to the headwinds. And one of the most clear headwinds that has shifted is the fact that headlines throughout the first half of this year actually were surprisingly positive on the housing market because there was this stronger than expected performance. But now as consumers gather some of their information about the housing market, they are seeing things like rates are hitting the highest levels since late 2000, or the home prices are unaffordable in 99% of US counties. So the headline effect is working against us, and we know, and we've talked about this for the past handful of years, how we're tracking the affordability constraints and how this is really, it's not a demand problem in today's housing market, it's demand at today's pricing levels. So if you layer in what we've seen with home price growth and interest rates, and you look at the payment to income ratio, generally speaking, you want to be at 30%. On the high level, you want to be kind of stretching the budget, but at 35%. And you can track even the traditionally more affordable parts of the country. Phoenix and Tampa, for example, are at that stretch limit or above. As you track down, you can see Indianapolis towards the bottom. Know that this is an imperfect measure. because I was just in Indianapolis, and when you go to the desirable parts of the market, this is really going to understate the problem of affordability. My key thing here is we have to acknowledge that every single one of these markets, if you look at history versus where they are today, they're in uncharted territory. And we have to figure out then, how do we continue to gain market share? How do we continue to be competitive with the buyers? And to me, this begs the question. If we're talking about this affordability shock and these higher interest rates, but you look at the run rate of new and existing homes based on the current trends, we're still going to sell 4.7 million homes this year. So yes, down from where it was at the height, but there's still a lot of people that are still selling, that are still buying. And to me, I want to understand why. Why are people shopping today? And from the new home point of view, the number one answer is that lack of resale inventory, which is filtering people into the new home space. The number two reason we've talked about in the past, it's that combination of relocating, of having children, of retiring, of getting married, of divorce, all of those things that you guys have heard me say before is the life happens housing market. There are times where the math doesn't necessarily say that people should go through with a transaction. Maybe you shouldn't be technically resetting a 4% interest rate for 8, but if you're in a house or in a situation where your home does not fit your life stage or lifestyle, we're finding that people are still willing to move. So we understand the why, but then, like I said, the main focus of this presentation is also going to talk about the who. Who are the people that are buying today? And I think it will surprise many people that the number one most active buyer right now is move up, even despite the headwind of the lock-in effect. And we'll provide some reasons why that's the case. Besides move up, we have entry level and we have relocation. So we're going to go through those three categories, and we're also going to apply it to demographic labels to be able to give you kind of this all-encompassing view of the overall buyer cohort. So where I want to start is we're saying, okay, move up buyers are the number one most active, and yet of those that own a home, 80% have a rate under 5, 60% have a rate under 4. How can we reconcile these trends? Well, to me, one of the answers is pretty easy. It's equity. Those that have already owned homes have been able to benefit from rising prices. And if you look at owner equity as a percent of total value, we're off from where we were at the absolute height of the market. And we'll discuss that more in a moment, but we're well above where we were over the past decade, or we're well above where we were in the mid-2000s. Now, equity, I think I can hear you guys challenging me now. Well, someone's home value has gone up, but every other house has gone up as well. Well, this is where you have to think about, how does the move up evolve? If you're in the absolute best submarket and you're trying to move up in the absolute best submarket, yeah, that equity is not going to be as big of a factor. But if you're moving to a slightly different part of town, if you're moving to a different city, if you're moving to a different state, we know that equity will play into the move up discussion. And we also know equity becomes really important with move down, which we'll talk more about in a few moments. But let's go to that point where if you look at the average equity gain and we say that we're off from the absolute high, but still elevated. I wanted to provide a little bit more context about that, especially by state. So the colorful map that you're looking at shows the average equity gained in the second quarter 22 over the second quarter 21. The gray chart shows you the average equity gain in second quarter 23 over second quarter 22. Now, what you'll notice is the gray map is showing that many markets have actually gone negative in that overall equity. And when this data is released, it's just highlighting some of that negative equity that's getting captured. And I think that that's an unfair way to look at the market, especially after looking at that line graph that we just saw. What we thought is more valuable is to look at what's happening with the cumulative effect. So taking Texas, for example, netting out those two numbers, the average household that owns a home in Texas is up $41,000 in equity. In Arizona, up $52,000 in equity. In Florida, $103,000 in equity, just over 2 years' time. And think, there's not a lot of people that just bought over the past 2 years. It's people that bought 2 years ago, 5 years ago, 10 years ago, 20 years ago, 30 years ago, and the cumulative equity there. So the key thing that we understand is it is easier to move when equity is involved, especially when equity is combined with wealth. So we'll talk about the most wealthy generation in a moment, but then you say, okay, we know there's the higher equity. Who is best positioned to benefit from it? Put simply, the propensity to own goes up with age. Let me rephrase it. Boomers have the highest homeownership rate, Gen X second highest, Millennial third highest, Gen Z fourth. So as you go down that list, you can see what group is going to be disproportionately exposed to those equity gains. And because we know that distribution, that's how I want to approach these slides, is looking at what we're seeing with boomers, some of the opportunities and challenges. Same thing with the other generations. Now, boomers, we know this is an absolutely vital part, not only of the economy, but also of the housing market. Now, before I talk about the boomers, one thing I want to acknowledge is sometimes we will interchange using 55 plus and boomers, and that is not technically accurate, but it's just our way to capture that 55 plus buyer, which would then fall into that active adult category. But as you look at boomers, they control the majority of the nation's wealth. They control the majority of the nation's assets, and they're also the most on the move. So going into the pandemic, we had a lot of data on the fact that the majority of boomers in most markets have not moved in over 20 years. And you'll still see some of those trends, but what has evolved since the pandemic is more mobility. United Van Lines captures that those 55 plus accounted for more than 55% of all of the moves that they captured last year. And the moves were fueled by three main categories: a desire to be closer to family, a new job or company transfer, and then this third category, which hits the boomer group spot on, is retirement. Every boomer will be of retirement age by 2030. And when you go back to the discussion of life happens, retirement is one of those big catalysts that often changes life stage and lifestyle and encourages a move. And in fact, that's exactly how we've seen the housing market evolve. If you think back from 2014 all the way up until 2021, the millennials, the largest living generation, the group that gained that reputation of never wanting to own a home, the millennials were actually the #1 most active shopper that entire period, 2014 to 21. Now, what has evolved and why I think the demographics are interesting is to layer in the demographics with affordability is that boomers overtook millennials for the first time since 2014 as the most active seller and the most active buyer. So we know that part of this can come from equity, part of this can come from overall lifetime savings, part of this can come from a change in lifestyle. Part of this, I would say, comes from that lack of overall interest rate sensitivity. So we know, and I mentioned earlier, 80% of those that have a mortgage have a rate under 5. But 42% of those that own a home here in the US do not have a mortgage at all. And where that's concentrated more so is towards those 55 plus. And this goes back to still being able to move in today's market, having some of that equity, and then specifically in the boomer case, also being in that move down category where there's not, assumably not a big jump in the monthly payment as they move. Though I know that a lot of boomers are begrudgingly annoyed that when they move down, their monthly payment actually doesn't go down as much as what we've seen in some past generations. So we understand the role of boomers. We're going to come back to them later as we talk about millennials, because as you look at who the boomers are parents to, it will be some Gen Xers and it will be some millennials, but millennials will capture that higher share. But before we get there, let's go to Gen X, because Gen X would now be our second group that has this outsized benefit to home equity, but Gen X will be more of those move up shoppers versus move down. And as you look at Gen X across the markets, you can see, generally speaking, you're looking at a 60 to 80% homeownership rate. And as you track where you have the higher homeownership rates, Denver leading the way, not necessarily an affordable market, but some of the others that top the list are areas where I think that conversion to homeownership is a little bit easier. But you think about Gen X, I think they have fewer life stage changes than what you're seeing with the boomers or you're seeing with millennials. So to me, to ask a Gen X to move, you really want to understand what matters the most to them. And so we captured this data from the NAR that looks at the factors influencing the neighborhood choice. The top thing the Gen X are looking for is that quality of neighborhood. Look down the list. What I think is interesting is looking at number 4, which is capturing the availability of larger lots. So that idea that a move up wants to feel like it is a nicer product or a bigger lot size. Still though, a concern about affordability, which you'll see across basically all of the generations. And then because of the Gen X and why I said it's not as big of a life stage change is the millennials oftentimes are having children or have younger children that are going to go into school. Gen X often has kids that are already in the schools. But as you build this out, we understand what matters to Gen X. We see that overlap with older millennials, that convenience to school being a really important factor. And then you look at the younger generations and you just see overall convenience is something that they highly value. But as you look across this list, to me, as I was tracking out these generations, I think there's a lot more commonalities than you think, which is good for our industry because it means you don't have to get too customer, too unique to be able to capture a wider net of the different buyer groups. But the third group, and I would say probably the last group that has been able to benefit from the outsized equity gain would be the millennials. So if you look at the millennials, we already talked about how they made up such a large share of overall transactions. The older millennials have a homeownership rate of 60% plus. So that is pretty much in line with what we saw for Gen X. And when you look at why people moved, it's all the reasons. I think I could tell you this is any generation and you would believe me. It's building my own equity. It's a change in my lifestyle. It's stability. It's appreciation. And what we've noticed about the millennial cohort is we have been serving them, I think, for the past 7 or 8 years. And as we looked back at 2019, so our pre-pandemic timeframe to today, we had more millennials that were purchasing smaller homes back in 2019. And the distribution has tilted a little bit more towards that 2,000 square foot plus, a pretty big bump in that 3,000 square foot plus. And what we think is this is not necessarily that consumers are demanding a higher home. It's that millennials over the past few years have evolved from being primarily first-time buyers to also playing in that move-up space. But I think the important thing, I think the last time we met, we talked about square footage and we talked about the evolution of square footage and how homes are going down in size. You do still have 62% of millennials that have bought their home under 2,000 square feet. So that's not even a survey of what are you willing to accept. That's hard data of what these consumers have said, you know what, it works for me. Maybe it's the right price point, maybe it's the right location, but perhaps I want a larger home. I'm definitely willing to take a smaller home if done right. When you look at this cohort specifically, you look at the millennials and you say, okay, well, what was your source of your down payment? The number one answer is cash savings. The second answer ties back to how we've mentioned move up a couple times. It's that sale of an existing home. But the third is where I wanted to tie the discussion back to the boomers. The third highest source that millennials would get their down payment from is from what we call the bank of mom and dad, help from a relative. And why this is important is we're saying, okay, boomers are the second largest living generation. Boomers are parents to millennials, the largest living generation. The millennials, among other cohorts, are finding that today's affordability challenges are a big deal, but their parents control the highest share of overall wealth, and 70% of boomers plan to give some or all of their money away while they're still alive. Now, this is a 2019 survey. It is clearly dated, but it's the best data that I could find on this. And to me, this becomes one of those to a certain population. I didn't have the bank of mom and dad. I know a lot of people don't have access to funds from parents, but for those that can, we think this is one of those kind of affordability workarounds that just works itself out over time for some, a very small subset of the overall population. Now, again, when you go back to what matters the most for this cohort, this is our survey. The other one was a top priority in a neighborhood. This is top priority in a home, although the responses still end up kind of describing the neighborhood. But as you can see, for those that have kids, it's that focus of schools and safety. For those that don't have kids, it's that focus on convenience. Specifically in the home, what we see is the number one priority is a garage, though I will say, we have examples from all across the country where we know that there is a desire to have a garage, but when push comes to shove, if it's a parking pad or a parking spot, but you can still afford a home in a good location, we definitely know that that's something that people will end up compromising on. A big yard or a social yard is a key part, and I think that's a differentiator that you can get from the traditional multifamily market. We know obviously the built to rent has been trying to offer the backyard as a differentiator also from true multifamily. A designated office space and a large kitchen. So we understand the priorities, we understand why people buy, we understand how they've been able to buy, but for those that have not been able to purchase yet, we then want to understand, well, why not? So in our survey, we said, if you're renting, why are you still renting? And the top 3 responses for the millennial cohort is, I'm waiting for home prices to come down. I can't afford in the location I like. I can't afford in general. So really no surprise that that is all about affordability. And that brings us to the last demographic cohort I want to go through, which would be Gen Z. Now, we need to nip it in the bud early. What we know is that Gen Z has proven to us through survey after survey that they do want to become homeowners. So we're not having the same narrative of, oh, Gen Zs never want to own homes. They do. And we actually have 56% of Gen Z that are already putting money away for their first home. We have 45% of Gen Z that are looking to purchase their first home over the next 5 years. But if you think about this cohort relative to the millennials, at least the millennials have a certain share that encompasses that move up, that already has experienced some of that equity gain. Just given the age of Gen Z, that they are that lower part of the overall population in terms of age, we know that not many of them have benefited from equity. And already 4 of their 5 top obstacles from buying a home come down to affordability. Not having enough for a down payment, finding a home in the right price point, not having good enough credit, or having too much student loan debt. As we look at the cohort though, and you think about Gen Z, in 2017, they represented 0% of the market, which again, makes sense, they were just too young. As this has evolved to 2022, you see Gen Zs now represent 9% of overall activity. Now, if you're looking at this, something may stand out to you as odd here, which is that millennials are above boomers, and that goes against what I said earlier, where boomers are above millennials. Why there's a discrepancy here is this is looking at people trying to buy a home with a mortgage. And we laid out the case for how many of those own their home free and clear. And that's why the share of the baby boomer looks lower than I think you would expect, because this is looking at loan activity versus total applications. For the Gen Z, when we think about this cohort, not as large as the boomers, not as large as the millennials, but still this opportunity to form these households, what we wanted to do is figure out where we find the highest share of them. The way we did this, and it's a very simplistic way, is to just look at the areas across the country where we have the lowest median age. And you can see Salt Lake City standing out as that lowest across the board. Then you see Houston, Colorado Springs, Riverside, San Antonio, Austin. For some of the Gen Zs that are moving, sometimes they move somewhere because of school and stay put. Sometimes it's lifestyle reasons, sometimes it's affordability reasons, and sometimes it's they were born and raised there. But if you think about Gen Z, we understand that they want to own homes. We understand that they're saving to buy a home. But we also understand that if they have graduated from school, if they no longer live with their parents, then they're probably renting. And what has evolved is the rent versus own equation. So for the past decade nationally, what we've seen is that the median monthly mortgage payment has been cheaper than the median monthly rent. Now, this was the case from 2010 all the way up until 2022, and we've experienced a sea change as of late. Rents have gone up, no denying that, but home prices have gone up, and it's really that combination of those higher interest rates, which is really pushing that monthly payment out. If you put yourself in the shoes of someone who's renting today, they're saying, okay, well, if I'm looking at my rent or if I'm looking at owning, it makes more sense for me to maybe rent. Know that that's a kind of a simplistic view on the market. That's just looking at the monthly expenditure. But if you think back to some of the generations and why they said they bought, it was also building equity. It was those other benefits of homeownership too. So I would say this is a challenge, this is an additional headwind, but it's also something that I think through education we can also work around. Now, we've talked about this before. So what are people doing then about the higher costs? Because it's really too easy to assume, well, people have two choices. They can rent or they can own. But remember, there's also a third choice. They can move in with their roommates. They can move in with family. They can recouple. Instead of forming a household, they can go back and move in with someone else. You see this during times of high rent, high home prices, high inflation. We shouldn't be surprised by that. But besides that, we know there's a lot of people staying put. We talked about the lock-in effect on the for sale side. We know from reading the REIT earnings calls on the rental side that they have a near record high number of renewal rates. So people in the rental community that are deciding to renew for now, at least as they weigh their options. We know people will look at homes that maybe are cheaper because they can be remodeled. We know that builders have gained that share for all the reasons we talked about earlier, looking at smaller homes, looking at different kinds of loan options that are available. And I think the key part of the market that has really opened up since the pandemic is moving to a more affordable part of the country. Now, many of you guys know I love to track migration trends. I think this is the most fascinating data. And the census is the key source that we use, but they only release the data once a year. So we were able to supplement this data with what we're finding from Bank of America, whereas we track out Bank of America through the second quarter of this year. The markets that you're seeing here have more people moving out than moving in. And probably no surprise, we're looking at a cluster of more expensive markets, of larger cities, and of select parts of the Midwest. If you look at where through the second quarter we still see more growth, you can see it's concentrated across the Southeast and the Southwest, some of the same regions where we're still seeing some of the higher overall job force growth as well. And the only market that should stand out to you here is the second market, Columbus, Ohio, where many of you guys know has a special place in my heart since I went to the Ohio State University. But you're finding that people are saying, okay, even the Southeast and the Southwest on that relative basis have become expensive, at least relative to where they were. And we are finding that some people are saying, well, what's the next best market? And somewhere like Columbus, for example, and perhaps I'm biased, but we do know it has a good foodie culture. It does have good culture, lots of diversity, lots of restaurants, different unique pockets. And I think some people are finding that desirability as they have a little bit more of that work from home and a little bit more awareness about overall housing affordability. So as we wrap all of this up, we understand the challenges and the opportunities of these different demographic cohorts, but I think one of the most important things that we know too is that more building can help. It can help with affordability, it can help with mobility, and we were making a lot of progress during the pandemic. We were seeing that growth rate of overall activity really before rates rose. And I think this is the biggest challenge with our industry is it's pretty well understood that there is this undersupply in the market, but it's difficult to be able to have a straight line up in growth when consumers stop and go. And when consumers stop and go, we see builders that stop and go. And we see this play out in the annualized data of second quarter. It's last 12 months, second quarter of this year. So it includes the pullback at the end of last year or early this year. Most markets down, single or double digits. But if you look at the second quarter on a quarter over quarter basis, you're seeing double to triple digit growth. So it's this fascinating thing where consumers pulled back, so builders pulled back, and then consumers are back again, and then builders are back again. And then it's this stop go that's just making it hard to fully backfill that inventory. As we're looking at the top markets for starts, we're led by Dallas, Houston, Atlanta, Austin, Phoenix. Pretty similar top 5 is what we've seen over the past handful of years. So like we said, there's some choppiness, some kind of knee-jerkiness of what's going on with overall housing starts activity. But what we know with pretty good confidence is there's still that enthusiasm with land acquisition. We saw at the end of last year, lots of builders pausing on deals, bidding lower, maybe moving forward, but being a lot more cautious. And as this year has progressed, and we've seen this for the past handful of months in our data, we have the majority of builders that are still full steam ahead on their land acquisition, definitely interested in backfilling any of the community count that's down, the homes that they've sold without replacing. There's still that interest in some of the longer term growth. Now, as we put together the comments from the builders, we have our survey that many of you know, and if you're not filling out our survey, please reach out to me. You can be included in it. But what we have is 70% of builders in our most recent survey that expect starts to be up next year versus this year. Now, I have a bunch of caveats that I need to add to this, but the first thing I would say is our builder survey is more heavily concentrated with public builders. And so I wanted to layer in, BTIG just did a survey and they did it with smaller builders. What they found is it's 40% are planning to start more homes. So I think the truth is probably somewhere in the middle, that there is still some of that enthusiasm to start next year. Now, our data is 36% of builders expect starts to be up more than 10%. I did this morning have a meeting with a big supplier. I met with their board, and their board really challenged that and said on the ground what they're hearing is more of a single-digit growth next year. And if you look at the responses, it's almost an equal amount that are saying up more than 10% and up at that 35%. You can see that how that distribution is broken out. It's just still a pretty similar number. The key thing here, though, there is that enthusiasm to build. There is that understanding of undersupplying and that building can help with some of the challenges that we're facing today. But this idea of increasing starts does come down to a couple key things. It's assuming that financing remains reasonable. It remains reasonable to the building community. It remains reasonable to consumers. And it also assumes that demand holds up. And like we talked about, we know that demand can be a little bit choppy, a little bit sensitive relative to affordabilities and relative to headlines. I think I've mentioned this before. This is a chart that I continue to keep in, though it's evolving as time moves on. The risks to demand holding up or the risks to financing holding up really tie back to some of the risks that we're watching with the Federal Reserve and the long and variable lags that many of you know about that are important to monitor. The office market is something that we've been watching and we've been nervous about for a long time. And obviously we haven't seen this play out into the broader system, but we're still just watching for any kind of challenges in the office side. And then of course, we're watching consumers, where 70% consumers represent 70% of GDP. They make up the largest share of the economy. And especially as time has gone on, they've evolved with how they're spending their money, how much savings they have. And I'd say most importantly, we have this new thing that we're watching with the resumption of student loans. So as many of you remember, we had the student loan forbearance where people didn't have to make their student loan payments. They didn't take a penalty, and that forbearance lasted up until October of this year. So we're just watching to see how that ultimately plays out in the market. So absolutely no doubt that there are risks. But I think the biggest thing is myself and many of you on this call and our builder and developer partners, we're not just looking at what the next 6 to 12 months look like. We're in it for the longer term investments, the longer term plays, and trying to think about where the market goes from here. And we were lucky enough to be in that environment of the, if you build it, they will come. But now as we think about the deals, we really just want to go back to the basics. And I think one of the important basics is tracking the employment growth. Now, let me describe this a little bit more, because as we look at employment growth, I oftentimes will show where we're seeing the most overall job growth or the most high income job growth relative to the pandemic. And that will capture our more near-term trends. But what we also know is these kind of basics, the fundamentals of employment growth, are also really important when you're thinking more about that long-term as well. And so the table that you're looking at, the first part is going to show you the top markets for total employment growth from 2010 to 2022. So led by Austin, Nashville, Riverside, Dallas, Raleigh. The next section over is showing you the top markets for high income job growth. Again, you see Austin and Nashville topping the list, San Jose, Raleigh again towards the top of the list in Raleigh. And then you also look at where we're seeing the top markets for the highest share of overall jobs. So to us, we think it's important to monitor where there's been an evolution, where economies have changed, but also where there's those longer term demographics that either come from the employment data, that come from migration, that come from the very localized supply and demand discussion. And for us, as we think about how the market moves forward, it's going back to those basics, understanding them, digging into the data, finding the patterns is the best key to success in good times and in bad. So with that, I think Mike Farmer, I'm going to bring you in for some closing remarks.
Allie, thank you very much. And with this being our last call of the year, I just want to take this opportunity to thank you for everybody on this call for helping us to navigate this year, Allie, and work and plan for next year. So these have been very helpful, and we just really appreciate all your insights. Before we go to the Q&A, and if you do have questions, feel free to put them in the chat box, and we'll get as many answered as possible here. Just wanted to reaffirm the Builders FirstSource commitment to our customers. And as you heard from Jeff and Steve, we have a dedicated sourcing and operations team that are here to make sure we have the products you need when you need them. And that's one of the biggest things we continue to talk about, is staying in supply and being able to provide the products as needed. We're really focused on trying to bring costs down, and one of the biggest ways we've invested in that is really through new facilities, adding lines in our manufacturing plants, and continuing to focus on M&A opportunities within key regions to help better service you from a value add perspective. A couple other areas we're really focused on is our long-term partnership with customers and finding ways to spend more time talking about how we optimize the job site than talking just about pricing and quarterly bidding. Finally, working with our mills and manufacturers to better position our customers is something our sourcing team is very actively engaged in. We're looking to bring new programs and really help support our builders in any way possible here. So with that, we'll jump it over to questions. I just want to thank everybody on this call very much. Allie, I'll send it back to you.
Awesome, thanks, Mike. We have some good questions that are coming in. Please continue to send them. We have about 10 minutes to go through questions, so we're happy to take them either to myself or to the BFS team. I think the one that stands out to me, it's a really good question, is you mentioned that homes are aging, and so they were basically asking about, is there data that shows how old the homes are, and then at what point does it become attractive to demolish and rebuild? So this is something that maybe next year, if we do this webinar again, I can bring back the data. I maybe hit on it a year or two ago, but one of the key things is if you look at the overall housing stock, we do know that we are seeing this growing share of homes nationally that are in what we call the prime remodeling years. So some of you may know Todd Tamilak. He's our building product and remodeling expert. And so he sees this really strong upward pattern just based on the age of those homes. But specifically to say what point does it become attractive to demolish and rebuild, that will really depend on the market. And again, this is the data set that you can either email me and I can send you what it looks like by market. If I remember correctly, you have a higher share of older homes in the more established markets. And the two that really stand out to me are Philadelphia and Los Angeles. And I think in those cases, you are finding the demolish and the rebuild. And in LA's case, very specifically, we're seeing how do we rezone that and create higher density, or maybe knock down one home and put a couple homes on that lot. When you look at some of the more young markets, places like Las Vegas, places like Arizona, I think there's less of that demolish and rebuild than you would find in some other markets, just given they have better developable land and the overall age of their housing stock is a lot younger. I'll move on to the second question, which is, when do you think mortgage spreads will normalize, even at a 5% 10-year? If the spread were to go back to normal around 150 basis points, mortgage rates would have a 6 handle, which seems to be below that 7% psychological barrier. So let me just give a little bit of context to this. I think many of you probably know about the spread between the 10-year and the 30-year, but it's important to just refresh your memory and then give a little bit of context around this question. So traditionally, what we would say is the 10-year treasury yield and the 30-year fixed rate mortgage have a 0.9 correlation, meaning they're almost perfectly correlated. And it's because mortgage-backed securities are an alternative to the 10-year treasury. And what's happened is because the Federal Reserve is going through quantitative tightening and they're letting some of their investments roll off their balance sheet, we've seen that there's been this imbalance in the mortgage-backed securities market, which is making the relationship between the 10-year treasury yield and the 30-year fixed rate mortgage evolve. So normally this person mentioned that it was a 1.5 spread. I think the historical average we use is 1.7, so pretty close. So normally you would pull up the 10-year treasury, you would add 1.7 to it, and that would give you your real-time, every day, what current mortgage rates are. Today, you have to pull up the 10-year treasury and add about 3 to it. So it's very ballooned. It's very different than the historical average. You do see it during times of evolving economic backdrops. But to directly answer this question, yes, it does seem like 7% is a psychological threshold. I think even 8% obviously is pushing it even higher. We think that 5 is probably really that level that you see the market loosen up, but we did see, like we talked about earlier, 6 is a place where people get comfortable. When that spread is to normalize, I think 2 things. We think we could see that spread normalize within the next 12 months, probably closer to the 12-month mark than 6. And that's just based on the historical time frame where normally the spread stays wide for 12 to 24 months. We know that we're in a unique period of time because of quantitative tightening, so we're not trying to rely too much on that historical guide, but we do think that over time we probably get to a point that it normalizes a bit. I don't know if we fully believe that it comes back to the 1.7 spread, but as we're viewing it, we think within the next year, you at least see the spread compress a bit. Actually, I usually avoid this question, but because I've done a lot of research for builders on it recently, I'll answer it, which is any interest rate predictions for 2024. So first thing I want to say is anyone forecasting interest rates should have the utmost humility, and I am the first to admit it, that it's very difficult to forecast because of what we talked about at the beginning. You don't know what is going to happen in the Chinese economy or what's going to happen with the currency exchange rate between what's happening in Japan and the US and how that plays into investors. So those are some of the things that are outside of our control. The absolutely horrific events happening in the Middle East, another event that's outside of your control, Russia and Ukraine, outside of your control. So there are these things that are the exogenous factors that we have to just say, hey, they may come and derail the forecast. When, I'm going to give you numbers, don't worry. When we look at mortgage rate forecasts, what we've seen is, I think the MBA, the last I saw, Mortgage Bankers Association, the lowest I saw, I think they were at 5.5 end of next year. I think it was Fannie Mae and Wells Fargo were, I think like 6.1 and 6.3. National Association of Home Builders, 6.4. We are at 6.1. Now, let me just give a little bit more context, which is we think it will still be bumpy from here to there. We don't think it's a straight line down from here. We think rates could even go higher. But the 2 things that are driving our forecast of being lower than where they are today would, one, be that question about the 10-year treasury and 30-year spread. If that we are anticipating that comes down, we do have that baked into our forecast. And the second big thing is a Fed rate cut. So if the cut does not happen, if the spread does not normalize, all bets are off for our forecast, but that's how we're viewing it. Let's see. Okay, so there's a question, are you seeing some incentives that builders are offering that seem to be more effective than others? I think this goes back to what we're saying of the mortgage rate buy downs. It's interesting. I would say it depends on the builder that you talk to about the mortgage rate buy downs. There are some consumers that see a 5% interest rate today when they know interest rates are 8. And there's some consumers that are saying, you know what, like that feels too good to be true. And almost in a good way, I feel like they've learned some lessons from last cycle. Like if something seems too good to be true, maybe don't do it. I think in the case of the 30-year fixed rate buy downs, they're not too good to be true. They're real. The builder's just having to pay a lot for them up front. But I'd say it's the marketing of incentives that I was just talking to a DP at one of the big public builders last week in Texas, and he was mentioning that the buy downs will get people into the door, but it doesn't necessarily guarantee that they get them. And so the key thing is you market something that is attractive on a mortgage rate point of view or makes the consumer feel like they have a deal, and then it becomes a very consumer to consumer specific story of the consumer saying, well, my biggest issue is I want to have a decked out kitchen. And then in that case, maybe it's the funds towards options and upgrades. Let's see. There's a lot here. Another one that I want to go to, let's see. What are your thoughts on people trading down to manufactured housing for affordability reasons? So let me reframe that, as I don't think it's necessarily trading down to manufactured housing, because I've toured a lot of the manufactured housing facilities that are out there, and oftentimes it's more efficient. It can be built quicker. It can be away from the elements. I think that there are some manufactured housing that will make it look more like maybe a trailer in a way that it does seem like a trade down, but definitely seeing more companies investing time, investing money to try to do alternative building processes to help address with affordability. We have found that, I think it was Clayton, they did a really good commercial just trying to show that in their insist, once you get inside the house, you can't tell the house is any different. So I think there will be an acceptance to it. I think there's still just a little bit of a reputational challenge. And I think in some places where people want to live, manufactured housing doesn't always work. But I think the evolution towards more efficient construction is definitely something that I think we're seeing in the building community and that consumers would be open to. Okay, given we have 3 minutes left, let me do 2 last questions quickly. There's a question that, is there data that speaks to the availability of land for new homes by market? And yes, you're speaking to the right person. Zonda tracks land and lot availability by market, by submarket, by street. We do have that data. We'll release our free press release on third quarter data in probably the next week or 2. So you can go to zondahome.com to see that. Or if you want to see more granular data, you can send me a message. Last question here, and I think, Mike, I'll pass it back to you after I'm done with this. Do you track the building of ADUs? And if so, how much has the market grown? So I picked this one knowing that I don't have a direct answer to it, but I will tell you, I just sent an email out to my team this morning that we need to be doing more research on ADUs. I feel like it's coming up in a lot more conversations because ADUs is, so accessory dwelling units, for those of you that aren't involved in that space, and it's a home that can be put on an existing lot or maybe behind a different home that could have a revenue stream where someone's renting in it, or you could sell it, but it also helps with overall affordability. We know in some markets across the country there have been zoning changes to help allow for it, but right now I don't have the direct answer of how much the market has grown, but know that it's something that we're researching. So with that, Mike, let me pass it back to you to close things off.
All right, Allie, thank you so much, and great job on the Q&A. And just want to thank everybody for spending the time on the call today and the rest of the calls that you joined earlier this year. Looking forward to bringing this back again next year, and we'll continue to try to provide all the updated information we can on what's going on in the housing market. So with that, thank you very much.